Well, the market is feeling good so far in June. The S&P 500 and the Nasdaq both reached new one-year highs, fueled by positive inflation data and the possibility of a rate hike pause. ETFs outside tech and that sphere also hitting 52-week highs, a sign that the tech-dominated S&P 500's rally is expanding. But not good news for all with money in the market, namely value investors. Proponents of the first time-tested buy cheap strategy have been hit by economic uncertainty, while the hyperfixation on AI has sent tech stocks and the broader market index soaring. The performance gap between growth and value stocks is the widest it's been in 2 decades. So what's the smart play? Here with us is Brian Frank, Frank Funds CIO and Frank Value Fund Portfolio Manager here. So what is the smart play now?
Boy, Brad, that was a tough introduction to being a value investor. Well, of course, the value guy is going to say the smart play is value, but I'll give you some numbers behind that. Sure. We have the highest dividend yield we've ever had on our portfolio before at the Frank Value Fund, approaching 3%. So these value stocks that have been left behind are paying shareholders for the privilege of holding them. And the other amazing thing is
But at what loss, though, too? Because if that's just on the dividend side of the equation, then what type of losses in the near term do they have to incur for continuing to be a shareholder as well?
Well, you would think that there would be some detriment to paying out that much to shareholders, but the crazy thing is these are defensive companies, so they're non-cyclicals. We actually rotated out of most of our cyclicals. We had a spectacular play last year with energy, even well before the Ukraine war. Energy was just such a screaming buy. But now that we're kind of worried about recession on the horizon, we've rotated into defensive stocks. So it's odd. They're defensive. They can keep their cash flows going during a recession and pay that dividend, and yet they're trading cheap to the market. You would think they would be more expensive.
That happened during the pandemic, though. You started seeing that, it's kind of like turned into a popularity contest instead of like what Brad talked about, like value investing has lost some of its kind of just favored the traditional stand by your man route. It's kind of falling out of favor. And you mentioned just the R word has started to kind of fall by the wayside. You're hearing a little less chatter about it, especially amid this bull run that we're seeing. Is that really still a concern?
Absolutely. The leading economic indicators have been negative for 11 months in a row now. That's never happened before outside of a recession, and it's also never happened before, period. Usually the leading economic indicators turn negative for about 6 months, and then we enter a recession. So I think the fact that they've been negative for so long, we've kind of been lulled to sleep here into thinking that this could be a new bull market and there's some exciting things happening with those growth stocks. But really, the economic data is pointing down right now, and nobody's considering that. Definitely the S&P 500 is not considering that. And you'd pay up for defense in an environment like that. But defense is cheap right now, which makes me happy, but it's also a tough position.
So really quickly then, just going back to the kind of the concept of the value play, you have a hot new IPO heading to the market, the Cava, the Mediterranean food chain. Is the value play now in the IPO space?
It really depends on the price. Google was an amazing value when it came out during its IPO, but some other IPOs that we've seen in 2021 have gone down 90%. So it really, you got to do your work. You got to look at the numbers.